Now, joining me now with more is Paul Gruenwald. He's a chief economist at S&P Global Ratings. Paul, it's great to have you in studio this morning. A lot to talk about,
yes,
as
indeed.
always, including some developments on the trade front. Based on what we know this morning, of course, the president insinuating that 80% tariffs on Chinese goods are the way to go. What does that mean for U.S. consumers?
Yeah, well, we've seen some screwy numbers so far, right? So we had a big surge in imports in first quarter, front-running the tariffs, and now we've seen a drop overnight in that number. Well, U.S. consumers are going to try to figure this out. They're going to end up paying the tariffs. The question is, on the production side, are these going to be continued to be produced in China? Or are they going to rotate to other countries? And that depends on the size of the tariffs and other stuff. So we just have to wait for the details.
So before we get maybe to more of the consumer impact, I do want to talk about some data out this morning that did paint a picture in terms of trade coming in and out of China. Obviously,
Yes.
nearly cut off between the U.S. and China. But what are we seeing with China and other countries around the world?
Yeah, well, there's two parts to that story. One is we had this surge of imports from China in Q1, and now that seems to be dialing back because of the front running. But if you go through the numbers overnight, it looks like China was able to redirect those to Southeast Asia and other markets for the time being. Maybe that's because we've done a pause on the reciprocal tariffs and we're getting this so-called rerouting. Again, we're going to have to wait to see the details. If the U.S. puts tariffs on everybody across the board, that rerouting is not going to work. So China's tariffs vis-a-vis, let's say, Southeast Asia are an important thing to watch in the next couple of months.
Interesting. And in terms of consumers, what kind of price changes can they anticipate with these tariffs, as you referenced earlier?
Yeah, well, I mean, the consumers, in our view, are going to pay most of the tariff. So the U.S. is kind of taxing itself. The government's going to rebate that with tax cuts later on the line. But
yeah.
Chinese stuff's going to be more expensive than stuff from the rest of the world. The question is, are we directing imports? Are we bringing stuff back to the U.S.? We think it's a pretty big stretch to say all this stuff's going to be brought back to the U.S. It may go from China to less tariff markets. But again, we'll have to see how that shakes out. The cost differentials between the U.S. and, say, Southeast Asia are enormous. They're much bigger than the size of the tariff.
Does the change to trade policy that the president is seeking make the U.S. more or less competitive?
A little bit more competitive, but probably not enough to drive the production back here. We know that this is the theory that's going around, which is the U.S. as the global reserve currency, which means there's always a demand for dollars. The dollar's a little bit stronger than it would otherwise be. That's a ding to competitiveness, but there's a lot of other stuff going on that are a lot bigger effects. But we're not going to bring manufacturing back to the U.S. With tariffs of the size we're talking about.
Interesting.
Yeah.
So that, of course, is part of the campaign, but not necessarily how you think this is all going to shake out. How do you foresee this playing out in the near to medium term? Yeah,
well, it looks like, based on what happened with the UK yesterday, that 10% kind of baseline tariff might be the new normal. So all countries may have to deal with that and then negotiate on top of that. What we're ultimately looking at is U.S. savings, right? The U.S. runs a trade deficit and a current account deficit because our savings too low. So if everything we're doing on the trade front and everything else lifts U.S. savings and we narrow those deficits, that's fine. If the U.S. doesn't change its savings behavior, and the fiscal deficit's a big part of that, we're just going to be playing whack-a-mole with the trade deficit popping up in different countries. So that's what we're watching from like a macro balance point of view.
And how are other countries faring, the rest of the global economy in this scenario?
Yeah, well, we had this kind of screwy negative Q1 GDP number with the U.S. because of imports. You look at other countries, they had kind of artificially high GDP in Q1 because they were the exporters who were getting stuff out before the tariffs. China was one. Ireland was another one, interestingly, on pharmaceuticals. So if you're a net importer, you had your trade kind of pushed, your GDP pushed down. If you're an exporter, it got pushed up.
Interesting.
Yeah.
So in terms of your anticipation for GDP growth going forward, how could that play out? What kind of revisions do you think might be in store for the first quarter as well?
Yeah, well, it looks like the imports were recorded more than the stocking, so maybe we get a revision. We're really just looking at the first two quarters. I mean, there's so much noise in the first quarter. Hopefully some of that unwinds in Q2. So our U.S. team is basically saying, let's just take the first half of the year. Hopefully all that will wash out. We'll get a better picture and a cleaner read.
What do you think is the right path forward for the Fed to take here?
The Fed is watching the data. They're on hold. They're watching the labor market very closely. We got another good print for April.
Yeah.
Unemployment's still low. So I think they're going to wait and see. We haven't been in this world before. We're back in the 19th century, right?
Yeah.
In terms of tariffs. The U.S. economy looks reasonably strong if you focus on demand. Labor market looks reasonably strong. We think they're going to be waiting to see until the fourth quarter. Maybe we get 2 cuts later in the year.
How do you anticipate inflation rising into the back half of the year?
Yeah, well, we're going to end up probably with a 4 handle on inflation by the end of the year. But we make a distinction between the level of prices and the rate of inflation, which is the slope. So we're going to get a jump in the price level from tariffs. That's going to push up the year-on-year inflation rate. That's probably going to peak kind of 4+, and then we'll be trending back down. If we get these so-called second-order effects, then the Fed's going to have a bigger challenge if that first-round tariff turns into more price increases. We don't think that's a baseline. We're going to get some scary inflation numbers later in the year. The Fed's going to be easy, and then we're going to hopefully get back toward 2.
How long is it going to take to work through those higher rates that you anticipated and many other economists anticipate?
Yeah, we're not going to get back to neutral, whatever that is nowadays, low to mid 3s for the Fed, probably late 26, 27 now. So this all got pushed back a year or so. The soft landing we were originally talking about for this year isn't going to happen. We stopped that narrative, and the rate normalization is going to be pushed out a bit.
So do you anticipate a hard landing?
No, but a less soft landing. We don't have a recession in our baseline, but we have U.S. growth starting 2.5, 3 this year, ending lower than 1. So big deceleration, but we don't have a technical recession. We don't have negative growth.
What does that mean for the jobs market?
It means the job market probably 4.75. We peak on unemployment, and again, that's that resilience we've been seeing since the COVID inflation shock. What we've been telling our internal, external stakeholders is watch the labor market. If labor demand starts to crack in the U.S., then we're going to be going to the recession scenario. If it holds up well, we peak kind of 4.75-ish.
All right. Paul Gruenwald, he's a chief economist at S&P Global Ratings. Paul, thank you so much for joining.
Great to be here.
Yeah, great to have you.